This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm co-host Dianne Crocker. I'm here with Manus Clancy. Well, Manus, what a week. If it felt chaotic, that's because it was. We had war in Iran erupting last weekend, sending oil prices sharply higher and injecting fresh uncertainty into global markets. We had private equity shares plunging again as concerns mounted over risky corporate lending. Software stocks sold off as investors questioned how AI may disrupt parts of the ecosystem. We had major brokerage stocks dipping. PPA came in hotter than expected. Treasury yields jumped. So, Manus, I think, why don't we break this into two parts? Let's first start with the big news, the geopolitical shock of Iran, oil, rising energy prices, and then we'll turn to private equity. So, what are your thoughts on the war in Iran and how the markets are reacting?
Certainly, the war in Iran wasn't a shock. It had been discussed for a long time that the U.S. was considering military action if negotiations broke down about Iranian nuclear ambitions, and that reality came over the weekend. On a human level, it's heartbreaking that Iran is a country of 90 million people. Many of them, I'm sure, are just like you and I. They try to put food on the table. They try to raise their kids. They try to educate them, bring them up to be hardworking and prosperous young men and young women, and then war has come to their country. One of the saddest things about this is that the older I get, the less I know and the less I'm sure about. And you see situations like this, and you ask yourself, is this the right thing for the U.S. to be doing? Is it the wrong thing? And maybe when I was 30, I would have all the answers, but now that I'm in my 60s, I have none of the answers. Like, we just don't know, was this a good idea, a bad idea? Was this necessary? And I find that so humbling right now. It's just humbling to know that there's just no telling, like, what the right answer is, what the wrong answer is. But in no uncertain terms, there are innocent people suffering now, suffering from deprivation, food loss, economic uncertainty, and it breaks your heart. I want to get into, the economic impact and the impact on the markets, but my heart goes out to the people in Iran, and my heart goes out to the servicemen that are protecting the U.S. here. I have incredible empathy for innocent people on both sides.
Yeah, that's well said, Manus. And it's something we weren't talking about last week. And now there's this lightning rod that hit the market over the weekend that really sends a jolt of unfortunate reality into everything that we talk about here on the podcast. And it's obviously so much bigger than that. From the market standpoint, obviously it all depends. Duration, geopolitical uncertainty over a long time frame would elevate risk premiums, cause lenders to pull back, just cause everybody to kind of just freeze, and take a risk off stance at a time when we were seeing a lot of momentum building. So we'll see what happens. And certainly our thoughts are with the service people as well as the people in Iran, as you said. What are your further thoughts on that, Manus, and Iran, and where you think this might be headed?
So we talked about the human side of it. We didn't talk about the economic side. And you also teed up the issue of PE firms and that turbulence as well. So let's kind of take it from the top. What we're seeing this week on the equity side is an awful lot of bumpiness. We've seen two meaningful sell-offs. Before we started recording today, the Dow was down 800 points. I think a day before it was down 1,200 at one point before pairing those losses. We're seeing a big sell-off. We've seen a huge spike in oil prices. I think West Texas crude this morning was about $80 a barrel. That was up from something like the 60s a couple of weeks ago, and it's up just 6% today. That's putting upward pressure on costs, right? We saw in one day, people were noticing that gas prices went up 30 cents in one day as a result of this. So that in turn is pushing bond yields higher. We've seen the 10-year move from about 3.95 10 days ago now to about 4.15, moving in the wrong direction. All these are interlinked. Higher oil, higher CPI expectations, higher Treasury yields, the sell-off in the markets. That being said, as painful as it is, I think that that's the least of the market concerns right now. I think what we've seen historically when we've seen things like October 7th, when we've seen the war in the Ukraine begin, when we saw the U.S. bomb Iran about a year ago, that these sell-offs, this increase in volatility, this turbulence is very short-lived. People have short memories with this. So unless the war in Iran really lasts a long time, and unless we start seeing things like $100 oil for extended periods of time, I don't think that that's the biggest concern right now, at least in the market sentiment. I think a much bigger concern right now is the PE story, and we can get into that. But before I do, just want to get your final thoughts on whether you agree or disagree on my take on the geopolitical.
It really comes down to duration and where it heads. I do worry more about the private equity side just spilling into the broader macro environment and specifically into commercial real estate. And it was interesting, Manus, as I listened to you talk, my brain went back to our conversation in last week's podcast where you outlined a glass half empty scenario versus the Goldilocks scenario. And the Goldilocks scenario had a bunch of reassuring green shoots. And, I'm sitting here thinking, wow, what a difference 1 week makes. And instead of a wide range of green shoots, we're seeing more, I don't know what to call them, brown spots, that really kind of move the dial a little bit more toward certainly worry and concern. But I do worry more about the private equity side and where that might head if it triggers significant losses, if it causes spending to pull back, if it ripples through and leads us into recession as a worst case scenario.
It's certainly the case that long before Iran reemerged as the top headline, there was big time concerns about PE. We go back to November of last year, Jamie Dimon talked about cockroaches, that lenders in the corporate loan space had lost their way, that had become undisciplined. And there was some evidence of that. We saw the bankruptcies of Tricolor and First Brands that reflected both, I don't know if you want to call it a blind eye towards the risks, lack of due diligence, maybe it was fraud. I'm not sure how this story will play out in total, but there were concerns late last year. I think that those concerns have only grown. I think that the gating of redemptions at Blue Owl and other places added to that. I do believe that the AI panic of last weekend, where people thinking that software firms are going to go out of business hand over fist because AI is going to make them irrelevant, added to that drama. And then this week we saw another failure. We saw the collapse of MFS in London, Market Financial Solutions, who was a lender in bridge loans in Europe. And we saw, I think it was BlackRock, writing down their position in a loan to MFS by 100%, assuming that the loan was now worth zero. The founder of MFS, I believe, has fled to Dubai. And there's big exposure among firms like investment bank Jeffries. So what began as a concern in November picked up steam in January and February, and then kind of hit peak levels right now, that people think that this PE issue is a problem, that big private equity players are sitting on a boatload of losses, and this threatens to become systemic. I am just not in that camp whatsoever. Howard Marks was interviewed today on CNBC. He and I agree on this. He thinks that this is not a systemic problem, but the market is taking it as such, and that is leading to a lot of the turbulence we see today.
It's certainly an emotional topic and an industry that kind of runs on sharp reactions, but I hope you're right. The other thing that I'm watching closely, and that this comes to a story that came out this week, is the labor market. So I think it's worth sharing and talking about here that there was an announcement by Challenger Gray this week that layoffs are slowing. And, that, to switch gears here, is at least a modestly positive signal. And what the report said is, well, hiring isn't accelerating meaningfully, as we talked about last week, and it's particularly poor in sectors outside of healthcare, which are growing. But here's this new report pointing to a deceleration in layoffs, and it's the latest sign that, maybe companies aren't pulling back as aggressively as some had feared. And if labor is stabilizing, then obviously that's going to be good for tenant demand across sectors like office, industrial, retail. So, that's why I was concerned when the labor market started to weaken late last year, and then we started seeing data reports that seemed worse and worse. So this is at least one glimmer of hope that, maybe makes me feel a little bit better about the labor market.
Yeah, it's an interesting part of the conversation because not only do you have companies and their employees, you also have this third aspect, which is the negative immigration story, right? People self-deporting or being forced back into the shadows of the labor force or being forcibly removed from this country that you don't even know how that factors in. Are people keeping permanent employees around because they don't know where the labor force is going to come from down the road if it continues to shrink or self-deport, things like that? I don't really know. But I did want to put some numbers around the PE side of things. I was looking at Jeff Feldman of CBRE. He is a commentator on LinkedIn. Frequently, he gives people a sense of which way the wind is blowing on the lending side of CRE and so forth. And he pointed out, as we did earlier, that baseline yields are up 20 basis points with the 10-year yield from about 395 to 415. But he also pointed out that risk premiums are probably up another 10 to 15 basis points. So all in, borrowing costs up maybe 35 basis points from 2 weeks ago. He was urging people to lock in while the locking in is good, if they could, before we saw another move higher. But I do believe that, and I'm just keeping my fingers crossed here, that should we see a quick resolution in Iran, should we see oil prices start to settle down into 75 and then 70 and then 65 again, if we see this resolved quickly, then I do think the green shoots narrative is back on. I think we see Treasury yields start to come down again. I think, in my view, the PE problems do not metastasize into CRE, and we get back into that Goldilocks area. But there is that big what if. That what if is if this becomes an 8-week endeavor where oil prices continue to surge, if people get really risk averse, there's really no telling how this goes. And it's very hard to make predictions when you just don't know.
It is, and so there are so many moving pieces on both ends of the spectrum. So, with that, let's jump into this week's Lightbox data dive. The January CRE activity index had a healthy 28% bounce in January over December. So that was a really nice start to the year because it brought that index back into the triple digits for the first time since October. So now, believe it or not, we're into March. So the big question is, once we get the final February data on environmental site assessments, on lender-driven appraisals, and on property listings, does the index continue to climb over that bounce we saw in January, or does it pull back? So I do have early data on February's activity on one of the three prongs, and that is phase one environmental site assessments. So those are our early indicator of the due diligence that happens behind loans and behind deals. So phase one volume was up 8% over January. So that was nice to see. I don't have the other two yet, but the index is coming out next week. So we'll see where that lands compared to what it hit in January, which was 110.7.
We keep our fingers crossed, right? That I think it all comes down now to how much turbulence we see. And as you mentioned, Dianne, how long this goes. And the lyric that just keeps going through my mind is from that Don Henley song, "The More I Know, the Less I Understand." Takes me back to my opening remarks about the war in Iran. And it just seems so accurate right now that talk about the blindest of the blind spots. We just don't know anything about where this is going right now, how it ends. And I guess maybe the wisdom that comes with my age says to me, sometimes just have to accept the fact that things are beyond your reach knowledge-wise.
Yeah. Yeah, very appropriate song for this week's news. And you can't miss a day of news because things just keep happening, good or bad. So for Did You Know, before we move into the deal discussion, I did pick a fun one, maybe because I wanted some fun news as a break from what we're seeing in the headlines. I had serious Olympic fever this year and the Olympics are over. So my thoughts go to LA, which is hosting the 2028 Summer Olympics. And from our Lightbox scorekeeper model, Los Angeles is the second largest market in the United States for environmental site assessments, and LA's volume was up 13% last year over 2024. So historically, the city that hosts the Olympics tends to give the local property markets a boost, whether it's infrastructure upgrades, mixed use, repositioning projects. So I think if history's any guide, Manus, we could start seeing some broader capital deployment in LA as the games get closer. All right, so let's jump into deals. I think we should start with data centers because they're really making the biggest headlines in commercial real estate and it's showing no signs of letting up. So, what do you have there, Manus?
Well, it's funny because AI was the darling investment from about May of 2025 till the end of the year. We saw shares of NVIDIA and Broadcom and others just go through the roof as people thought there was endless opportunity in AI. And then there was this pause where people said the spending on AI is unsustainable. The capital costs may not justify the future benefits, or the future profits may be so far off that the return on investment is low. We also saw panic about, will AI put enormous numbers of companies out of business? But the one thing that never stopped is people are acquiring land hand over fist for data centers. That part of it never lost any momentum. And we saw three news stories last week that underscore this point. The first one from the Washington Business Journal's Michael Niebauer, CoLogic paying $375 million for the Ashburn Industrial Park. That's 4 times the property's assessed value. This is in what's known as Data Center Alley in Ashburn, Virginia. The property itself called the Beaumead Corporate Park. They acquired it, CoLogic did, from Merit Properties. A second one, 2 Baltimore centers acquired for $222 million by GI Partners. Capital One Bank provided a $113 million acquisition loan, reporting there by Simona Tudos, I hope I'm pronouncing that correctly, of Commercial Property Executive. And then a third one, this one just came out today. This comes from Gail Kolonowski of Commercial Property Executive. Amazon Data Services has acquired a 122-acre campus in Northern Virginia from George Washington University. Amazon paying $427 million for the asset, $3.5 million per acre. And this is, again, in that Ashburn, Virginia neighborhood.
It's such a hotspot. And that first story that you mentioned went for 4 times the property's assessed value. I mean, that is just astounding. And that part of Northern Virginia is now being referred to as Data Center Alley because it's the densest cluster of digital infrastructure in the world. And the Baltimore one was interesting to me because, I thought, well, maybe Baltimore is emerging as the next big data center market if land constraints and power availability are starting to push developers out of Northern Virginia, which is so hot right now, and starting to kind of bleed that interest into adjacent markets like Baltimore.
Yeah, the downside of the story, we've seen some of this too, although I haven't seen anything this week, is you do see more and more local opposition. You may not be seeing it in that Data Center Alley area that you were referring to, but you've seen it in other neighborhoods where people come together and say, thanks, but no thanks. We don't need this investment here. And they might be wise here. We do know that data centers are intense power consumers. I think people are right to question who's paying for this power. Will this spill over and push our own electric bills higher? So a lot to watch here. And there may be markets that are very favorable for this, and there may be ones that are not favorable business climate wise. We'll have to see.
the pitch of opposition is increasing. And so for any developer, they have to go in, not just paying attention to site selection and power availability, but kind of take the pulse of the local community and try to anticipate how much pushback there might be, because it is definitely starting to affect development timelines as opposition grows.
Well, you certainly don't want to drop 400 million on a property without knowing what you could do with it. And that's,
Yeah,
what some of these guys are facing if they go into hostile communities.
for sure. So, all right, let's jump to office. I know you have a couple interesting ones here. What do you got?
Well, we have a broad range of geographies, and we'll run through these in short order, but we do have a theme here. And the theme is quality of life matters. And I'll start with a story in Minneapolis. The Lumber Exchange building in Minneapolis sells for a buck, $1. Reporting there by Caitlin Anderson of the Minneapolis St. Paul Business Journal. This is a building that was built in, believe it or not, the late 1800s, a Class B building. It touts itself as the first skyscraper constructed in the Twin City area. The buyer was Space Unlimited, paying that $1 for the property. The property last sold for $24.3 million. So basically 100% loss on the equity, or the value, I should say, not just the equity, the value of the property over a short period of time, 7 years. And this is not unheard of in Minneapolis. We've seen a lot of buildings sell for those huge discounts. We've also seen it in St. Louis. We've seen it in Philadelphia. We've seen it in Seattle. You're going to have a story shortly about Portland. And I do think that if we were to do a correlation between the quality of life among certain cities and the size of losses people endured over the last 5 years on offices, there would be a very, very tight correlation. And the other side of the coin here, just to complete the thought, in Miami, Moisha Mana bought a property in the Flagler district. The property is known as One Downtown, a Class A office tower. It was formerly known as the SunTrust International Center. 75% occupied right now, so not super high occupancy. But here, the purchase price of $110 million represents only a 14% discount from the sale price of $127 million in 2018. So you contrast the losses you see in markets where people have said enough's enough, versus one in Miami where quality of life has remained high. People have been flocking towards it. The market is buoyant. And that's where these numbers become very, very apparent, right? In San Francisco, we saw things consistently sell at 70 and 75% off. You don't see that happening in markets where people feel good. And I just wanted to point that out right now, that the office story has a lot of tentacles to it. Quality of life, supply, willingness to push back to office as part of the lifestyle, like Jamie Dimon has done. So a lot going on there. I'm interested in your thoughts, Dianne.
Yeah, it really speaks to how much differentiation that there is from one office market to another. And we've used the word bifurcated, so much, and that really applies. You mentioned Portland, and I want to go to another story in office there. Our loyal listeners might remember that last year we talked about an investor who went into downtown Portland and bought the iconic Big Pink building, is what it's called. And that's the nickname for folks who aren't familiar with Portland. It's the nickname for the U.S. Bancorp Tower. And he came in and bought that property at a steep discount, and now he's back. There was a story this week by Jonathan Back at the Oregonian. The buyer is Jeff Swickard, and he bought Big Pink last year for about $45 million. And he just acquired the neighboring Five Oak office building. It's a 267,000 square foot property, and he got it for just $10.5 million. Manus, that is a 67% discount from what it sold for in 2014. And interestingly, the buyer is, and I remember this from the Big Pink story, he's an auto dealership magnate from Las Vegas. I think he went to college in Portland, so he has a soft spot in his heart for that city. And he's in the process, kind of like a game of Monopoly, of assembling a downtown cluster of office buildings that he's grabbing at extremely distressed pricing, and he's really betting on the long-term urban recovery in Portland.
Fortune favors the bold, and I think there'll be people like him that 10 years from now we'll look back on and say, man, why didn't I do that? These things, they were practically giving these away. I mean, when you think about that lumber building in Minneapolis, that's half the price of a Reese's peanut butter cup, right? You can't get a Reese's peanut butter cup for $1 anymore. So I think people will come out, buying these things at deep discounts, putting some money in and coming back. But it does underscore my earlier point. Portland was another one of those cities, lots and lots and lots of quality of life issues over the last 5 years. And I think that's why we're seeing these 67, 70, 75% discounts. I do want to point out another story from Portland while we're on the topic. It's not the only thing selling at a discount. It's not just offices that get hammered in terms of property values when quality of life diminishes. It's all property types. And this particular story comes from Sarah Edwards of the Portland Business Journal. The Portland Marriott downtown waterfront was purchased by Sculptor last month, Sculptor and Tamarack Capital, for $30 million. The seller there, DiNapoli Capital Partners, they bought that asset for almost $83 million in 2013. So it's not just office that gets caught up in this whirlwind of declining values when a city gets a reputation for not being safe or having other issues about it. It's really all property types.
Yeah, indeed. But, 13 years ago, it went for 83 million and now it went for 30. So, there are these investors, they're looking at a 500 plus hotel on the river in Portland and saying, you know what, at this basis, we'll take the bet. And, they have conviction, obviously, that they think that the long-term fundamentals will improve. I spent time in Portland last June at a conference, and I have to say I love it. Like, it has a really fun kind of artsy vibe and cool downtown on the river. So I know they have their problems, as you alluded to, Manus, but I hope it works out. And their motto is, let's keep Portland weird. So we'll see what happens there.
One of the most incredible things I saw ever, and I don't think I've told this story before, but it is Portland centric. You remember back 30 years ago that if you wanted to go from New York to Boston, they had shuttles. They didn't have scheduled flights. You just went to the airport and you got on a shuttle and they said, this plane's available, like a bus. You pull out your credit card, you'd get on. I think there was a Trump shuttle for a while. There was the Eastern shuttle. There was the United shuttle. And it was like a bus. You would get on and you would take that from New York to Boston. You pay your $90 and be done. And it replaced scheduled airline routes for a period of time. But the most incredible thing I ever saw, and this is like right out of a David Blaine magic show. Back in those days, NBA teams did not travel with private jets. They traveled coach. And the Portland Trailblazers had to go from New York to Boston for a game. And these guys that were 6'10 and 6'11 and 7'2" were putting themselves into coach seats on a shuttle plane. And it was like watching David Blaine put himself in one of those like 8-inch by 8-inch boxes. One of the guys was 7'2", 290 pounds. And it was incredible to watch.
Oh my gosh. That is a funny flashback. I do remember those shuttles. I took the one from New York to DC many times back in the day.
I know you want to get to some more hotel stories. Should we move on?
Sure. Have at it.
The next category, lodging, we already talked about that Portland story. We have a couple of hotel sales. There's been a lot of hotel sales happening over the last 2 or 3 weeks, some big numbers being out there. We saw hotels in South Florida and in Jackson Hole sell for over $1 billion, $1.1 billion a couple of weeks ago. We saw a Central Park South hotel sell for over $300 million, a Soho property in New York over $100 million. The one we haven't talked about, another nice one here, Ashford Trust is going to sell 2 hotels, one in New Mexico and one in Florida, total of $153 million, but it hasn't closed yet, so you won't see it in public records. But it's the La Posada de Santa Fe Resort and Spa in Santa Fe. That's going for $57 million. And the Hilton St. Petersburg Bayfront, that will trade for $96 million once this deal closes.
It's interesting, Manus. I feel like we've been seeing more and more hotel deals just in the past month or so. And generally, when we put together our transaction tracker report, we generally cover the four major food groups: office, industrial, multifamily, and retail, because those typically account for, 80, 85% of all the deals that your team tracks in any given month. But I'm starting to think as I listen to you, we might have to give some attention to some of these big hotel deals that are coming down the pipeline.
It's a little bit puzzling, honestly, that these things are trading right now because we're concerned about a lot of things, right? International travel, since we put tariffs in a year ago, is reportedly way, way down. The properties we're talking about that are selling are really high end properties that would be very attractive to somebody with money to spend coming from a foreign country. We also talk about the US economy teetering a little bit. People worried about layoffs, people worried about expenses. It's curious to see this uptick in sales happening now at the luxury end, and I can't really explain it. Maybe it's just a one-off, or maybe people see something that I'm not seeing.
Well, it brings to mind what we've talked about on the retail end, which is the K-shaped recovery and the fact that spending by folks in the higher income brackets are going like gangbusters, whereas folks at the other end of the spectrum are pulling back. So I imagine it's that same trend feeding into travel spending. And that's what's making these higher end resorts look more appealing to investors than just your standard run of the mill Marriott or Hyatt.
That makes sense. Yeah, I like that explanation.
All right, Manus, public service message for all the listeners so you don't forget. This weekend, we set the clocks ahead 1 hour as we move into daylight savings time. So, Manus, think about this. If you had 1 extra hour this weekend, how would you spend it?
Well, that's a great question. As people know, we moved the clock ahead. I think it's from 2 a.m. to 3 a.m. or maybe 1 a.m. to 2 a.m. So if you're giving me that hour in the middle of the night and it's available to me, I think I'm probably just going to catch a few more Z's. If you're giving me that hour during the day, it has been such a brutal winter, not only in New York, where I spend some time, but here in Western South Carolina, where I spend most of my time. We've had ice storms. We've had 70-mile-an-hour wind days. We've had several snowstorms. We've had a couple of inches of snow. I'm going to use that extra hour to go outside, put on some shorts, enjoy some 70-degree weather, take an hour-long hike, maybe put a little color into my pasty complexion, and enjoy some outdoor time. It's been way too long.
That sounds perfect. I'd love to say I'd use it productively, but realistically, I'm starting to see the window close on winter. The days are getting longer and the temps are creeping up. And as much as I talk about skiing, I have not made it onto a mountain once this season, and I don't think that's ever been the case. It's just been so busy, and my kids have both skied way more than I have. And while I don't have any hopes of being able to keep up with them anymore because they both ski much faster than I do, I don't want to completely lose it. So I'm feeling like it's now or never, and maybe I'd use that hour to start closing some distance between me and the nearest mountain that still has decent conditions.
Love that.
All right. We'll close there. Thank you to our producers at Bruning Media. Join the team every week as we share CRE news and data in context. You can listen on any of your favorite podcast channels, and you can send your comments or questions to podcast@lightboxre.com. As always, thank you everybody for listening, and have a great weekend.
Let's go.